Look, if you are over 40, we need to talk. Your 401k, your IRA, that pension you've been building for 20 years, there's a really good chance it's way more exposed to AI stocks than you think. And I'm not talking about some sci-fi prediction here. I'm talking about right now, today. Most people have no idea how concentrated their retirement money actually is. And when things get shaky, and they will, that's when it matters. So stick with me for the next 10 minutes, because I'm going to break down what's actually happening, who's at risk, and what you can do before it becomes a problem. Here's the thing nobody's really saying out loud. The stock market right now, it's insanely top-heavy. Just a handful of companies now make up a historically large share of the S&P 500, 40%. Microsoft, Apple, Nvidia, Google, Amazon, Meta. That's it. That's the list. And when markets get this concentrated, the damage doesn't show up on CNBC first. It shows up quietly in your 401k balance, in your utility bill going up because data centers are sucking up all the power, in layoffs that get blamed on AI efficiency. And most people don't realize it's happening until it's already too late.
Okay, so before you freak out and sell everything, don't. That's not what this video is about. I'm not here to scream crash at you and farm clicks. What I am gonna do is walk you through what's actually fragile right now, what's solid, and how people who've been through this before protect themselves when hype meets reality. Because here's the truth. Smart money doesn't panic, they prepare. And that's exactly what we're going to do. Quick note, this is general education, not personal financial advice. Everyone's situation is different, so think of this as a framework, not instructions.
So let's start with the big misconception. AI is real. Nobody's arguing that. ChatGPT works, self-driving cars are getting better, chips are faster, models are smarter. But here's where it gets messy. Adoption doesn't equal profit. Spending doesn't equal revenue. And hype definitely doesn't equal a sustainable business. Sam Altman, the CEO of OpenAI, recently acknowledged something important in public discussions. He said their $200 a month pro subscription, they're losing money on every single user. Not breaking even, losing. The more people use it, the more money they burn. Now, think about that for a second. This is a company that's been discussed in the media as having a valuation in the hundreds of billions of dollars, and their premium product is a money pit. Most bubbles don't pop because the technology fails. They pop because the math stops working. And right now, the math is getting real shaky.
Real quick. If this kind of breakdown helps you think clearly, instead of just reacting emotionally, do me a favor and hit the like button. And subscribe if you haven't already. This channel isn't about hype or panic, it's about protection. Alright, let's keep going.
Now, here's where things get weird. You know how in 2000, dot-com companies were just burning cash with no real business model? This time, it's different, but not in a good way. See, back then, it was small startups going bust. Today, it's the biggest companies in the world playing a very expensive game of musical chairs. Here's how it works. Nvidia sells AI chips to Oracle for, say, $40 billion. Oracle uses those chips to build data centers. OpenAI pays Oracle $300 billion to use those data centers. But here's the kicker. A big chunk of that $300 billion, it actually came from Nvidia in the first place. Nvidia invested $100 billion into OpenAI a few months earlier. So Nvidia's money goes to OpenAI, OpenAI's money goes to Oracle, Oracle's money goes back to Nvidia. Everyone reports record revenue. Everyone's stock goes up. And the whole thing starts to look like, I'm not going to sugarcoat this, a very expensive game of hot potato. Goldman Sachs has a term for this. They call it circular financing. It's like paying yourself with a credit card and calling it income. It works great until it doesn't. To be clear, this isn't illegal or hidden. It's a pattern that can emerge during capital-intensive growth phases, but it does increase risk.
And that's just the surface. Because underneath all this, there are real cracks forming. Energy grids that can't keep up, companies spending billions and getting zero return, retirement funds that are way more exposed than they should be. I'm going to show you exactly where the weak points are and who's actually going to feel it when this thing breaks. Let's keep going. All right, so let's talk about the cracks that aren't making headlines yet. First one, energy. You know what powers all this AI? Electricity. Tons of it. Estimates suggest data centers already consume around 1 to 2% of the world's total electricity. Doesn't sound like much, right? But the International Energy Agency says that number could double by 2030. And here's the problem. Most of the US power grid was built in the 1960s and 70s. It's running at about 15% reserve capacity. That means we're already pretty maxed out. Meanwhile, China, who built their grid way more recently, they're running at 100% reserve. They can just plug in 1 million more GPUs tomorrow and they're fine. We can't. Goldman Sachs says new large-scale power capacity in key US markets won't come online until 2028. So what happens in the meantime? Electricity prices go up. And guess who pays for that? Not the AI companies. You do. Your grocery bill, your heating bill, all of it. US electricity prices have nearly doubled in the past 3 years. And part of that, yeah, it's because your neighbor's asking ChatGPT to write their wedding vows. Second crack, return on investment, or lack of it. MIT just dropped a report that should have gotten way more attention. They studied companies using generative AI. Guess how many are seeing a positive return? 5%. 5%. That means 95% of companies using this stuff are getting zero ROI. Not a little disappointing, zero. The tools look great in demos, but the second you drop them into real workflows, they fall apart. One study found that AI actually made coding take 19% longer on average, because developers were spending all their time fixing the mistakes the AI made. It's like hiring an intern who's really fast, but constantly wrong. You end up doing more work, not less. And yet, companies keep spending. Why? Because no one wants to be the one who missed the future. It's FOMO at a corporate level. Every CEO sees their competitors slap AI powered on something and get a stock bump, so they panic and do the same thing. Not because it works, because they're terrified of looking like the dinosaur at the robot party. So let's get real about who's going to feel this when it breaks. Because it's not going to be the CEOs. It's not going to be the venture capitalists. It's going to be normal people. First group, anyone with a retirement account. If you've got a 401k, an IRA, a pension, there's a really good chance you own a ton of AI stocks without even knowing it. Most global equity tracker funds are 70% US stocks, and US stocks right now, they're dominated by tech. Apple, Microsoft, Nvidia, Google, Amazon, Meta. If you're in a target date fund, a Vanguard total market fund, an S&P 500 index, you're loaded up on this stuff. And when the market's going up, that's great. But there's a thing called sequence of returns risk. It's a fancy term for when you lose money matters just as much as how much you lose. If you're 55 years old and planning to retire at 65, and the market drops 40% next year, that's devastating, because you might be forced to sell at the bottom just to pay your bills. And once you lock in those losses, there's no getting them back. Markets recover.
bad timing doesn't. Second group, late retail investors. These are the folks who just started hearing about AI stocks in the last year or two. They see Nvidia up 200%. They see headlines about the next big thing, so they jump in, and they're the ones holding the bag when it pops. It's the same story every time. The early investors, the ones who got in at $50 a share, they're fine. They can ride it out. But the person who bought at $500, they're cooked. Third group, workers in AI-washed companies. This is the sneaky one. You've probably seen the headlines. Amazon lays off 10,000 workers due to AI efficiency. Sounds like AI is taking jobs, right? Except it's not. Here's what's actually happening. Companies are using AI as an excuse to cut headcount. They blame the robots, fire people, rehire quietly a few months later at lower wages, and pocket the difference. A recent study found that at least 5% of workers fired because of AI were rehired within a year. Same job, lower pay. AI didn't replace them. Management just wanted to cut costs, and AI gave them cover. So if you work at a company that's suddenly obsessed with AI transformation, watch out, because you might be next.